So another common question is, if there's wiggle room potentially in the sales price of the home, do I offer the seller less or do I request a seller concession toward closing costs and prepaids instead? Well, it's a good question. The thing we always want to default to is math. So if we use math in this instance, now closing costs can greatly vary based off the time of year, property taxes. A lot of the closing costs above and beyond the down payment percentage are non-fees like prepaid taxes and insurance and daily interest. So let's just use a round number. Let's just say $10,000. So if we're able to eat and use all that up and then apply any overage toward like buying the rate down through a little bit discount points, that's fine. But just for round numbers, let's use 10,000. Now your down payment could be, let's say 3%, 5%, 10, 15, 20. In this instance, I'm just going to use a 20% down payment example on a $500,000 purchase. So let's say you offer $500,000 and your loan amount is going to be $400,000, which is 20% down. So the question is, do I reduce that and offer them $490,000, which then my loan amount would be $392,000, or about $8,000 less than the loan amount? If you were to do that on the lower price, you'd save about $53 per month. Okay. Now, in lieu of that, if you were to offer the full asking price of $500,000 with a $400,000 loan, although your payment might be $53 higher, you're essentially saving $10,000 directly out of pocket. So what you do is, if you take the cash, now think of it as cash is king, and you have $10,000 and you divide that by $53 a month, well, that's about 189 months to recoup that, or about 15.75 years. Now, there's a lot of variables into that based off other amortization schedules and different things you can run. But for the simple math of it, my opinion and our opinion is that the seller credit toward closing costs and prepaids, if you can use it, will always be better in lieu of a price reduction because of those variables. Now, if the credit's too large, then you can start talking about things like, is there any overage to use toward a temporary buy down, like a 2-1 buy down, which we can talk about and help you with too. Or do I use it just toward closing costs and prepaids, which will directly reduce my out-of-pocket funds. I can then have more in savings. I can have it for an emergency fund. I can set up auto payments on the mortgage. It just gives you more comfort knowing if repairs come up, you have more cash in the bank. So if you do the math, I think the math will favor the credit toward closing costs and prepaids is better than the price reduction. Now, that's assuming, of course, that the price of the home is favorable in the market. It'll comp out with appraisal comps and the appraised value. However, it's always good to look at seller credits as an option in lieu of just assuming that a lower price will pencil and make the most sense. So we're going to include a link down below with the max seller credits based off product and down payment as a percentage. All those percentages should be well above what you need, but any questions we can help with in Oregon, Washington, or Idaho, reach out anytime. Thank you.